All right, so in my opinion, this is one or was one of the easiest POA papers we had in a while. Huh? This paper here. The first question was a journal question. This is stuff you would have done in Form 4, literally would have done in Form 4. They said House of Razzle Dazzle upon who these have with these names, boy. Anyway, I'm gonna leave them. I'm gonna leave them. House of Razzle Dazzle operates a clothing and accessory store. Next thing is somebody real business. The following list of transactions occurred during October the 24th. And they list out all the transactions. And then they say use the forms provided on pages 5 to 7 to prepare the journal entries for the above transactions. You'll see label each journal on the line provided, record entries for each transaction in the appropriate journal, complete general journal entries with suitable narrations. So when you're in your general journal, we have to put in narrations and balance and rule the cash book at October the 31st, 2024. All right? So they gave us space to do all the journals, which I did out already, but we will go through each of them to see if we can figure out where it's supposed to be recorded and how we would record it. So October the 3rd, received an invoice for goods for resale from Z Fashion House 6,000 less 25% trade discount. So an invoice is used when goods are sold on credit, right? If I sell somebody goods on credit, I would give them an invoice. If I purchase goods on credit, I would receive an invoice because the company would give me an invoice letting me know how much I owe. So in this situation, October the 3rd, received an invoice for goods for resale. Are we buying goods or selling goods? What do you think? We buying. So which journal do you record credit purchases in? Purchases journal, correct. So I went to the purchase, I opened a purchases journal, I put the date, October the 3rd. The details is just the creditor's name, nothing else. We bought it on credit from Z Fashion House. I record Z Fashion House as the details. Yeah? Right, I'm gonna show you that now. Under folio is PL, oh no, wrong place. Under folio is PL. And then now, when you get a trade discount, it is subtracted immediately. You don't have to record it in any discount account or anything like that. Trade discounts are not recorded, but they are subtracted. So I would calculate 25% of 6,000, which is 1,500, and subtract it. So the amount I recorded in the purchases journal was 4,500. You're following so far? Not too difficult, right? Cash register tape showed cash sales totaling 13,954. Which journal records all cash and bank transactions? The cash book, right? Right. So this one would have gone in the cash book. It's a cash sale. When we get money, what do? Debit. And when we spend money, in this case, it's a sale. So are we getting money or spending money? Getting. So it goes on the debit side, right? So I went into the cash book. I'll rotate. Put the date, October the 6th. Details were sales, folio is GL, and I put the amount under cash because it was cash, right? Now for the folio, once it's not a person, the account goes in the general ledger, right? So sales is not a person, the folio will be general ledger. If it is a person and it's on the debit side, the folio will be SL. If it's a person and it's on the credit side, the folio will be PL, right? Let me go back up. If it's a person and it's on the debit side, it will be SL because you have to sell something for them to be paying us money, right? If it's on the credit side, it will be PL because we had to purchase something for us to be paying money. The next one, paid advertising expense in cash, 2,600. Which journal? Which journal records all cash and bank transactions? Cash book, right? If we pay in expenses, debit side or credit side? Credit, because we're spending money, right? So again, I went to the cash book, October the 7th, advertising, that is not a person, so the folio is GL. $2,600 under cash. Banked $10,000 cash. Which journal? Banked $10,000 cash. Which journal records all cash and bank transactions? The cash book. So it's cash book again, right? What type of transaction is that when it affects both your cash and bank columns? Contra entry. So you're again on, but right? So you banked $10,000 cash, right? So you put in money into your bank account. Is your bank increasing or decreasing? Increasing. So you're going to record that 10,000 on the debit side on the bank. The details will be cash. You're taking your cash to do it. So is your cash increasing or decreasing? Right. So you'll credit cash and the details will be bank. And then you'll put the C to represent contra entry. Put the C in the folio. All right. So far, so good. All right. Next one. Received a credit note from Z Fashion. So credit notes are used when goods are returned, right? If somebody returns goods to us, we would give them a credit note. When we return goods, we will receive a credit note. So if we received a credit note, who is returning the goods? We are, right? So the company is returning goods, right? So the goods are going into the company or out of the company? Out. So which journal would that be? Return outwards journal. Very good. So we received a credit note from Z Fashion House for goods returned as damaged, costing $1,800 less 25% trade discount. So again, when it have a trade discount, it's subtracted immediately. So I'll calculate 25% of 1,800 and subtract it, which I believe would give us 1,350. So I'll open a return outwards journal. I'll put the date. The details is just the person's name. Again, you don't have to put anything else. Folio for return outwards journal is PL because we had to purchase something for them to be able to return it. And then the amount will be the 1,800 minus the discount. All right, next one. Received an invoice. If you receive the invoice, are we buying something or we buying something or right, we are buying something because when we purchase on credit, we will get the invoice. Very good. But pay attention to this one, right? I'm sure a few people get this one wrong. Right? Received an invoice totaling $4,790 for additional shelves and mannequins for business use from display house. If you put, this is a fixed asset because this is for business use and it's shelves and mannequins, right? That they're going to be using over and over for a long period. It's okay for a long period of time, right? Which journal would you record this in? The purchase of fixed assets on credit. Will it go in the purchases journal? So did I get that one wrong? Correct. The purchases journal only records credit purchases of goods. This is a fixed asset, so it's not a good for resale. All right? It can't go in the cash book because no money passed. Same thing with petty cash book. Nothing is being returned, so it can't go in return and what's the return outward, so it has to go in the general journal. All right? So we are getting shelves and mannequins, so our fixed asset is increasing. So you'll debit shelves and mannequins, and then you'll credit display house to show that we owe them money. So we go into the general journal, debit shelves and mannequins, credit display house. And then we put a narration, that's a small description of what the transaction was. To record fixed asset purchase on credit. The 18th, issued an invoice. If we give the invoice, are we buying or selling it? Good job. Issued an invoice to Queen Bee for goods 3,600 less 15% trade discount. So since we're selling on credit, what journal is that? Sales journal, correct. So open a sales journal, put the date, Details is Queen B, folio SL, and they gave a trade discount, you have to subtract it immediately. So I'll calculate 15% of 3,600 and subtract it. I believe that's 550. Oh, I think, let me see. And yeah. And then we subtract it. No, 540, sorry. Subtract it, we get 3,060. Next one, the 19th. Return 1,200 worth of additional shelves purchased on the 14th of March. All right? The return inwards and return outwards journals record goods that are being returned. The 19th. Return the 1,200 worth of additional shelves purchased on the 14th of March from display house. So you return inwards and return outwards journals, they record goods that are being returned, not fixed assets. So where would this transaction go? In the general journal again, right? So your shelves are decreasing because you're returning some, so that will credit. And then you're owing display house less. So your liability is decreasing. When liabilities decrease, what do you do? Right. So debit display house, 1,200, credit shelves and mannequins, 1,200. To record the return of a fixed asset. So to record the return of shelves or anything like that, right? It doesn't have to be exactly this. 25th, issue a credit note. If we are issuing a credit note, are we returning goods or are goods being returned to us? Goods being returned to us, correct, right? If you can remember, if you go up to the 18th, you'll see that we sold something to Queen B. So it could only be that they're returning to us. Right? For goods, 460 less 15%. So if they're returning to us, the goods are coming into the company or going out? So what journal are we using? If we come, right, say it with confidence. Return inwards, correct. So we'll open a return inwards journal here. Date October 25th. Details Queen B. Folio is SL. So return inwards, folio is SL. Return outwards, folio is PL. And it had a discount, 15%. So we have to subtract that 15%, right? Which is what we did, and that's how we got 391. PL. Right? You had to purchase something to be able to return it. Return inwards is SL. Well, we had to sell something for them to be able to return to us. Right. The 27th, almost finished. Paid the fashion house by check for settling of the account at the date less 2%. So here what we have to do now, we have to figure out how much they was owing us first. So, no, we have to figure out how much we were owing them, sorry. So at the start, we purchased goods from the fashion and we got a discount. So we were owing them 4,500, right? But then we returned goods to them. Remember, return outwards, 1,350. So I have to take that 4,500 and minus the amount we returned, because we're not owing them for that again. So we're owing them 3,150, right? But we didn't pay them 3,150. We got a 2% cash discount. So in my cash book, we'll be recording it. I calculated 2% of 3,150 and cash discounts are recorded. So I recorded it under discount received, and the amount I would have paid would be the 3,150 minus that discount. And that's how I got the 3,087 here. You all seen it? Right. And then the last one was Queen B, I believe. Yep. Received a check from Queen B in full settlement of its account at this date, less a cash discount of 175. So now I have to calculate how much Queen B was owing us. In the sales journal, we see they were owing 3,060, but they returned 391 worth of goods. So they're not owing for that. So the minus 391. So they were owing us 2,669. And we gave them a discount of $175. So on our debit side, because they're paying us money, I'll record Queen B SL, and I will record the $175 discount and subtract it from the amount they was owing us, and that's how much they paid, $2,494. So now that all of our transactions are recorded, it's time to total out. What's that? Where is it 12,000? Oh, I mean to total out, to get the totals. All right, so what I did the journals first. Journal, let us get the totals on debit and credit, make sure it was equal. Purchases journal, when you're doing the total, you have to put transfer to purchases account. Sales journal is transfer to sales account. Return inward is transfer to return inward account. Return outward is transfer to which account? Return outward to be transferred to return outwards, right? Right? Sales journal, when they total in it, the details will be transferred to sales account. Purchases journal will be transferred to purchases. Return inwards will be transferred to what? And return outwards will be transferred to return outwards, right? It's in the name, so you can't forget. Right? The folio for all of these will be GL. Right? So I did those, and then I balanced the cash book. Right? So discount columns are not balanced. They have no balance carried on or brought down. They do not need to match. They are two completely different things. Right? They do not need to match. Right? Discount allowed is an expense. Discount received is a revenue. The cash columns and the bank columns have to be balanced, however. Yes? Yeah. The cash discounts, the cash account and the bank account have to be balanced, however. So the first thing we do when we are balancing a cash book, we look at the cash column first. We check to see which side is bigger, which side is smaller. Now the cash column, the debit side should always be bigger or at least equal to the credit side. It's physically impossible for you to spend more money than you actually have, right? If I have $250, the most I could spend is $250. I cannot spend more than this. It's physically impossible, right? So your balance carry down always goes on the side that's smaller. So for your cash columns, the balance carry down will be going on the credit side because the credit side will always be smaller or at least equal to the debit side. So I go to the credit side, I put the date, October the 31st. The details is the balance carry down, BLC/D, and the amount is the difference between the two sides. So I take the bigger side and subtract the smaller side from it. So 13,954 minus 2,600 minus 10,000. And that's how I get this 1,354. This is how much money I have remaining. This is all the money I get on the debit side, all the money I spend on the credit side, and this balance is the balance of money I have remaining. Then I do the same for bank. I check to see which side is bigger and which side is smaller. Now it's possible for you to spend more money than you have with the bank because the bank offers a facility known as bank overdraft. So for the bank, the balance carried on could be on either side. But in this case, the debit side is clearly bigger. It have 10,000 and then it have 2,494 here. On the credit side, it just had 3,087. So the balance carried on also goes on the credit side. I add up the bigger side minus the smaller side, and that's how I get the 9,407. Then I put in my totals. As I said, the discount columns could be different. That's okay. but the cash column should be the same on both sides, and the bank column should be the same on both sides. And then finally, I put in my balance brought down, which goes on the opposite side of the balance carried down under the totals. It will be the first of the following month, balance brought down, and it's the same figures of as the carried down. This just means I'm starting off November with $1,354 cash in hand, $9,407 cash at bank. That was how much, Max, boy? 1220. On this, it will vary from person to person, but you have 3 hours, 5 questions, that is 36 minutes each. I define that question should take you 36. Maybe a little 20 minutes. If you know what you're doing, it take you 20 minutes. So I had some questions that came later on that were really time consuming. You'll see what I'm talking about soon. Number two, they asked there some pretty easy questions, right? In my opinion. So they started off They started off with Brown Leggy Limited. Manufacturers, 1 second. So number 2 now, Brown Leggy Limited manufactures animal feed and has many employees. Define each of the following pay systems which Brown Leggy Limited may use to calculate gross pay. So first one, fixed rate. If you get a fixed rate, again a salary, right? It's just a fixed amount that you get monthly or fortnightly, a predetermined amount. So if you work extra or you work less, you're getting the same amount, right? That's what a salary is. Hourly rate is basically you getting paid per hour based on the amount of hours you work. Piece rate based on the amount of items you produce. So if you're making chow and I make 20 bags of chow, I get paid per bag of chow. I might get paid $5 per bag of chow I make. Commission plan is when you get paid for selling items. So let's say you work in a car dealership and you sell a car, you'll get paid a percentage of the value of the car. Or if you're in real estate, that's why real estate people just make a little bit of change, right? Even if your commission is 3%, imagine 3% on a $3 million house that you sell.
Is the same thing for Geneva?
I'm not sure. I guess some may have a commission, but some may also just have salary. And then bonus is when you get paid a reward on additional, an addition to your income, most likely for accomplishing a certain goal. Right, that's 5 marks. Then they said, complete the table below to show the name of the account and ledger affected when posting totals from journals identified below. So remember in the first question, we had transfer to sales account, transfer, right? That is how you post the ledgers, right? So that total in the sales journal would be recorded in a sales T account in the general ledger. That transfer to purchases account, that total is actually going to go into purchases T account and so forth, right? So they want to know what would be affected when they do it and what the double entry would be. And they did one first. So when you transfer to return inwards account, from your return inwards, you would debit your return inwards account. You'll remember when to debit and when to credit. Pride, purchases, return inwards, drawings, expenses, PRIDE, always debited. Your return inwards account will be debited. And then the receivables account, the person who returned the goods, they would be credited, right? They would be located in either the sales ledger or the general ledger. If it's most likely the sales ledger, but if it's a fixed asset you purchase and they return it, that could go in the general ledger, right? Return inwards account is not a person, so it will be found in the general ledger. Sales, remember the sales journal records all credit sales. So all of these sales come from accounts receivable, people that owe your money, right? You'll credit your sales account because sales is always credited, and that will be found in a general ledger. And then you would debit your receivables account. All right, those will be all the different people that owe your money. You'll credit it in their account, right? Or you could use a sales ledger control account, which is basically all of your receivables combined into one account. And your receivables will be found in a sales ledger. The last one, return outwards. All you have to do really is copy what you had for return inwards, but put like the opposite. So return inwards is on the debit side, return outwards is on the credit side. They found any sale account receivable, trade payables. If somebody didn't know what to do, they could have simply do that, right? But return outwards is always credited. So you would credit return outwards, and then the debit would go into the trade payables account, the person who you return the goods to. Trade payables are in the purchases ledger, or if it was a fixed asset, might have been the general ledger, but mostly the purchases ledger, right? And return outwards is not a person, general ledger. To B, complete the table below to show the name of the account and the ledger effective and posting totals from journals identified below. You have to see the double entry and which journal it will be in. And they gave an example. First one, journal return inwards. You know that's transferred to return inwards account. Return inwards is always debited. Remember Pride, PRIDE, purchases, return inwards, drawings, expenses. Those accounts are always debited. So you debit the return inwards, which will be found in a general ledger. Once it's not a person, goes in a general ledger. And then the returns will come from accounts receivable. People that were owing their money and they bought the goods on credit and they return in it. So you will credit the account receivable account. They will be found in the sales ledger. The second one, sales. Your sales journal records all credit sales. So all of these sales would come from accounts receivable, which are found in a sales ledger, right? Sales is always credited. So you would credit your sales account. Sales is not a person, so it goes in a general ledger. And then you would debit your account receivable, right? The account receivable will be increasing because they are buying stuff from you on credit, and when assets increase, your debit. And all accounts receivable are found in the sales ledger. Return outwards transfers to return outwards account. Return outwards is always credited. Remember, Pride is purchases, return inwards, drawings, expenses. Those are always debited. Once it's not in Pride, it's going to be credited. So you credit the return outwards account. The return outwards would come from trade payables. People that you bought from on credit and you return it to them. So you would debit your trade payables because when you return to them, you're now owing them less. And when liabilities decrease, you debit. And your trade payables will be found in your purchases ledger. Let's move on. This almost everything here is form for work. This is really easy. This is a accounting principle question. They give you 5 accounting principles and assign a letter next to each. And you're supposed to read the situation and put the correct letter next to them. They put 5 accounting principles, but only 4 situations. So you won't be able to automatically guess one. Because if you get 4 out of the 5 and it just have 1 remain, and it's at 5 situations, you obviously know where the 5th one goes, right? A true and fair view is exactly what they have in the last one. Brown Leggy Limited ensures that all financial statements are accurate reports on the performance of the company. It shows a true and fair view of the company's financial status. You're not committing fraud, you're not making mistakes, you're not lying. All right? The first one, Brown Leggy Limited applies depreciation charge on assets each year over their economic useful life. So they are recording the lowest possible value of their assets. That's A, the prudence concept. Then the next one, it is a policy of Brown Leggy Limited that all accounting information should be based on verifiable evidence. Isn't that objectivity? Right? Going based on facts and not opinion. The third one, sales are not recognized when goods are paid for in advance. According to the accruals concept, they only record what is meant for the period. So that would be the accruals concept. So that would be E. Going concern, a company is considered a going concern if it's expected to be in operation in the foreseeable future. None of those situations said anything like that. That's why going concern was left out. D now was our ratios question. This is the first question that they might do in Form 5 instead of Form 4. Brown Leggy Limited decided to compare the company's ratios on the 31st of December 2025 with those on the 31st of December 2024. All right, and they gave us 2024, 2025 receivables collection period, payables payment period, right? Each of the ratios shown above suggests two possible reasons for the change. So in 2024, it took us 45 days to collect from receivables. In 2025, it took us 35 days. That could be for a number of reasons. Once you put a reason that makes sense, you will get a mark. So what I put was that in 2025, they may have offered more cash discounts. Because remember, cash discount is given for prompt payment. And that might have encouraged them to pay faster. Or they could have given smaller credit sales. Right? So you could have approved less larger credit sales, which will make it easier for account receivables to pay back their money on time. Or you could have put anything once it made sense. They could have put they had less credit sales overall, and they sold only to more reliable account receivables, people who weren't owing before, things like that. Once it makes sense. And then in second situation, they took longer to pay the payables, right? So, one of the suggestions was that we got offered, well, Brown Leggy, sorry, got offered less discounts. So they took longer to pay. Or they had less cash available, so they couldn't pay. That's why they took longer to pay in 2025. You could put anything again for this one as well. These are the only 5 answers you could choose. Once it makes sense as to why it take them longer to pay, you could say they may have been taking part in a particular business venture, and now they had less money available or something like that. Anything that makes sense as to why it would take them longer to pay. Right? That makes sense, huh? E. Identify one possible outcome which could result from the business not having adequate working capital. Right? Not having adequate working capital, it may not be able to pay your workers on time. It may take longer to pay your debts. It may not be able to buy all the inventory you need. You may need to take a loan. Anything like that, right? Not having enough working capital is not a good thing. It affects your day-to-day operations, right? You might end up with a larger amount of accrued expenses. Anything like that would have worked. And that is the whole of number 2. Don't know when next one you will see a easy paper like this. Number 3. There you hope. Number 3A, define the term depreciation. This is the loss of the value of a fixed asset over a period of time. 1 mark. You don't have to go into too much detail. B, on January the 1st, 2023, Carly Jonas, the owner of Carly's Manufacturing Company, purchased a delivery truck costing $50,000. He is undecided on whether to charge depreciation using a straight line or reducing balance method, and has made the following decisions. Useful life is estimated to be 5 years. Estimated scrap value is 10,000. Depreciation rate for the reducing balance method will be 25%. The asked us to come to calculate depreciation for the 2 years using the straight line value in one method and the reducing balance method on the next side, right? Straight line method, the formula is the cost of the asset minus scrap value divided by the number of years of useful life. The thing with the straight line method, the depreciation is not going to change. It's going to be the same every year. So all you have to do is calculate it once. Once you calculate it once, you could just put the same amount for 2023 and 2024. Simple as that. So I took the cost of the asset, which is 50,000, minus the scrap value, and then divided by the number of years of useful life. 50,000 minus 10,000 is 40,000. 40,000 divided by 5 is 8,000. So that for the 2 years. The reducing balance method, you would have a different depreciation every year, and it will be smaller every year. Hence the name reducing balance method, right? It's the net book value of the asset multiplied by the depreciation rate. The net book value is the cost of the asset minus any depreciation it ever had. So in the first year, it didn't have any depreciation. So it would have been 50,000 multiplied by the depreciation rate of 25%, which is 12,500. In the second year, it would have had depreciation. So you have to calculate a new net book value, which would be 50,000 minus that 12,500, which is how we got it to the 7,500 by 25%. Boom, 9,375. That is 5 marks. January students will get through. Then they gave us possibly the easiest manufacturing account I have ever seen CXC give in the history of manufacturing accounts. Never seen an easier one. They didn't put any twists and turns. They didn't add any direct expenses. They put all the factory overheads in one. It was a real simple one. So manufacturing accounts are prepared for companies that make their goods instead of sell it, right? So instead of using purchases, because you're not buying to sell over, you're making the goods, is have to calculate the production costs. And the production costs is all of your direct costs plus all your indirect costs. Simple as that, right? The direct cost would be the cost of the raw materials they used, your direct labor, how much you pay your workers, and your any direct expenses that you may have had. And then your factory overheads are your indirect costs, like your rent, if you rent the building, if you have a manager that is pay a salary to, things like that. You're paying lights, paying depreciation on, well, you have depreciation on fixed assets in the factory, things like that, right? You didn't have to guess your factory overheads because they told you the factory overheads. So all you had to do, calculate the cost of raw materials used, which is the opening stock of raw materials, are the purchases of raw materials minus the closing stock of raw materials. That'll give you a cost of raw materials used. Add the direct labor, which they gave you. That will give you a total prime cost. Then they told you all of your factory overheads was 141,250. So you add your factory overheads to your prime cost to get this 468,750. Then the last part of the manufacturing account, if you know how to do a manufacturing account, it's real easy. You add the opening work in progress, that's the goods they start to make but you didn't finish, and you minus the closing work in progress, and that's the production cost, and that was 7 marks. Once you know how to do manufacturing accounts, this will be real easy. This is the simplest way it could possibly come. Then D, they said the company manufactured 22,500 units. Compute the unit cost of production. So if it cost 470,000 and it was to produce 22,500, to calculate the cost per unit, you will take the total cost and divide it by the total units, which is what we did here. And we got $20.89 per unit. Then they asked us to calculate markup. You remember when we did markup in class? That thing that was going to be the start of. We did that when by Form 5? All right. So to calculate markup, you will take the selling price and you will add 1 plus the markup percentage. All right. So the markup percentage was 60%. So you will add 1 point, you multiply it by 1.6, sorry. So we took the cost of the asset, which is $20.89, and multiplied it by 1.6, and that's how we got the selling price, $33.42. 2 marks. The company sold all 22,500 units. Operating expense is 20% of sales. Calculate the value of expenses. So if the selling price is $33.42, and we sold 22,500 to calculate sales. We just take the total units multiplied by the selling price. Once we get that figure, we know expenses is 20% of that figure. So we just multiply that by 20%. That is 3 marks, and that is number 3. Number four wasn't difficult, but number 4 would have taken some time to do. So number 4 is a stock valuation question. They said Ray's Appliances shop sells small kitchen appliances, including air fryers. He uses the AVCO method for inventory control and valuation of the air fryers. This was a long time coming. I haven't seen them bring AVCO in a while. They always bring in first in, first out, and last in, first out. It's about time they bring it. A, identify one other method of inventory control. We know all 3 are FIFO, first in, first out, LIFO, last in, first out, and AVCO. So they mentioned AVCO, you could have put first in, first out, or last in, first out, whichever one. You didn't do that yet? That's okay. Well, you'll do it soon. It's a very small topic, don't worry. It ain't gonna take long. State briefly how the method identified works. First in, first out means the first set of goods that come into the company is the first set of goods you're going to sell. Last in, first out means the last set of goods that come into the company is the first set of goods you're going to sell. All right? That is last in, first out. Right. Then they said B, during the month, we had the following information, right? So we start off with some goods on hand. We purchase some, sell some, purchase some, sell some, purchase some, sell some. And they want us to complete the form provided to record the inventory valuation of air fryers using AVCO. AVCO stands for average cost. It means when we valuing the cost per unit, we just calculate the average cost. The average cost will be total cost divided by total units. So it takes a little while to do, but we got it done, right? So we started off on December the 1st with 502 units that were unsold at a cost of $200 each. So 502 units, the average cost was $200. So the total value of the inventory would have been 502 multiplied by 200, right? Then they said we purchased 125 units at the cost of 230 per unit. So on the 6th, the inventory is coming in because we're purchasing it. So we recorded under cost of inventory in. The cost of the inventory would have been 125 multiplied by 230 because 125 units and it costs 230 each. So we calculate it, get the total. Say total unsold inventory is now the 502 that you had before, plus the 125 you just bought. Say total unsold inventory is now 627. To calculate the average cost, you'll take a total cost, which is the cost of the 502 inventory, plus the cost of the 125 you just bought, and divided by your total units. And you get your cost per unit. Every time you purchase new goods, you have to do that calculation, which is why it takes some time, right? So now that you know your cost per unit, your value of your inventory would be a total inventory, 627, multiplied by your cost per unit, which is $205.98. Right? 13th, you sold 257 units. Those goods are going out, so you record it under out. Right? The cost would be 257 multiplied by the average cost that you just calculated. And that's how we got this figure. See, a new unsold inventory would be the 627 minus the inventory you just sold. That's how we get 370. The average cost doesn't change. The value of your inventory is now the 370 multiplied by your average cost. See what I mean when I say take long, right? This question will take long. The 19th, you purchase 175 units. That goes under inventory in. 175 units, and it cost us $205. So it'll be 175 units times 205 to get the cost all the units. Your total unsold now would be the 370 you had before, plus the 175 you just bought, 545. And the average cost would be the total cost, which would be the 76,000, plus the goods you just bought, divided by your total units, 545. So a new value of your goods will be the 545 multiplied by the new average cost. And that's how you're going for all of them. The 23rd is sold 322. That goes under in cost of inventory out. 322 multiplied by a new average cost to get the total cost. The value of your good, the total amount of goods you have unsold now will be the 545 minus the 322 you just sold. So 223. Cost per unit doesn't change. Your total cost will be the total amount of goods you have multiplied by the cost per unit, which is what we did here. Only two more. 29 to purchase 200 goods. So that goes under the inventory in column. 200 multiplied by, it costs 260. 200 multiplied by 260, 52,000. The total goods you have is now 223 plus the 200 you just bought, 423. The cost per unit is the total cost, the cost of the goods you had before, plus the cost of the goods you just bought, divided by your total units, 423, $238.13. So your total cost will be the total goods you have multiplied by your cost per unit, $100,728.99. Finally, 30th of December, you sold 410 goods. That will go under inventory out. 410, the cost would be 410 multiplied by the last cost per unit, so 97,633. The amount of goods you have remaining will be the 423 minus the 410 you just sold. That'll leave you with 13. The cost per unit doesn't change. The value of the goods you have at the end of the year will be 13 multiplied by $238.13. And I say we get the $3,095.69. Now, I know that might have seemed confusing. Once you go through, once you actually learn how to do average cost, it's not difficult, it's just a bit time consuming, which is why it's good if you could finish your other questions as fast as possible while checking over your work and stuff. In case it have questions like this that could take up a lot of time, right? Because this would have taken up a lot of, it took me a lot of time, and I knew exactly what I was doing from start to finish, right? I had no confusion, nothing I was worried about. It was just time consuming to scroll up, scroll back down, go to the next page, go back to the next page, calculate this, right? So factoring, it may have questions like this that not hard, but time consuming. And if you have questions that you could finish fast, finish them quickly, right? So then they ask, calculate raise total cost of purchasing air fryers for the month. So the cost of inventory in would be every time you purchase goods. So it would have been the 6th, the 19th, and the 29th. To get my total purchases, I would add the cost on those days, the 28,750 plus the 42,875 plus the 52,000. And that will give me my total purchases. Then he asked us to calculate. They said he sells the air fryer for $650 each. And they wanted us to calculate total sales. So what I would do, I would go into the inventory out, add up all the goods that he sold, 257 plus 322 plus 410. And then I'll multiply that by the selling price. And that's how I got my total sales. So I have my total sales here. I have my total purchases. This at the start here would be the goods you start off with, which is what do we call that? The goods you start off the year with. Opening what? Opening stock or opening inventory. This is the value of the goods at the end of the year. What do we call that? Closing stock or closing inventory. So I have my sales, I have my purchases, I have my opening stock, and I have my closing stock. And they asked us to do an income statement up to gross profit or gross income. So I used those figures. I took my sales, then I calculate my cost of goods sold, which will be opening stock, add purchases, less closing stock. That gave me my cost of goods sold. I subtracted from sales and I got my gross profit. 6 marks. That was number 4. If you've learned stock valuation already, that is 20 marks.
That's 20 marks.
Yeah, that is an easy question. Yeah, every question is 20 marks. If you learn stock valuation already, I'm pretty sure you get all 20 out of 20 in that one. Number 5, Costco Sports Center has a health, recreational, and social facility. The trial balance on the 31st of December 2024 did not agree. So already we know it's an errors question, right? When the trial balance doesn't agree, what account do you use? Say it with your chest. Starts with S. Thank you, your suspense account. So we know it's going to be a suspense account question because the trial balance didn't agree. Right? It was short on the debit side by 368. This was entered in a suspense account. You see the play there already. So we know it's going to be a suspense account question, but that doesn't mean it's going to only be a suspense account question, right? They can mix in errors that do not affect the trial balance with errors that do. We have to be able to identify the difference to teach, right? Then it said the accounts clerk discovered the following errors. And then the question asked, so it is important to read the question. Prepare the suspense account to correct the errors from the table above, which require correcting by means of the suspense account. That means for this part of the question, all they're looking for is the errors that would affect the suspense account. Start with the difference from the trial balance, and then total the account. Now, once you correct all of the errors that was in the suspense account, there should be no balance remaining. Your debit side should be equal to your credit side. If that doesn't happen, then most likely you forgot something or you made a mistake, right? So the trial balance was short on the debit side by 368. So the accountant would have opened the suspense account and put 368 on the debit side so that the debit side and credit side would be equal. So that's what we have to start off our suspense account with. The balance brought down of 368 on the debit side. Now let's read the errors. The first error, the total of a page of the purchases account was 6,842, but it was carried forward as 6,824. So that was an error that happened on the purchase account only. Would that affect the trial balance? Yes, it would. Remember, for the trial balance to balance, the debit side and the credit side must be equal. If it's affecting the purchases account only, it's only affecting one side. So that would cause the trial balance not to balance, right? So it was supposed to be 6,842, but they put 6,824. Did they put too much or too little? 6,842 is what they were supposed to put, but they put 6,824. Too little, right? So when they calculate it, they put $18 too little. So the purchases is always what? Debited. So to fix the purchases account, we would have had to debit it 18. And when it corrects an error that includes the suspense account, the next half of the double entry is always in the suspense account. So if we debit purchases 18, what are we going to do to suspense account? Every transaction is an equal debit and an equal credit. If we debit in purchases 18, what do you do to suspense account? If we debit purchases, we will do credit it 18, right? So we'll go to the suspense account. Details will be purchases. We'll credit it $18. The next one, well, I put the thing on the board already. A check received from DEC Limited had been credited into the account of DDE Limited. What type of error? Well, I have it on the board already, but when I put the amount in the wrong person's account, that's an error of commission. You remember that? And that is one of the errors that do not affect the trial balance. So that's not going in the suspense account. So we could skip that for now. The third one, the balance of the petty cash book 200 had been omitted from the trial balance. So that would have caused the debit side of the trial balance to be less by 200, right? So now that we know that that is an error that we did, that is part of this 200, that is part of this balance brought down of 368. You put the 200 in the trial balance, and then you would subtract the 200 from this balance brought down. How do we subtract from the debit side? By doing what? Putting it on the credit side. So we will credit the suspense account 200 to take it out from that balance brought down. The next one, purchase fixtures on credit from TS Supplies had been debited to TS Supplies and credited in the fixtures account. What was supposed to happen when you buy fixtures, when you buy a fixed asset and a fixed asset increases, you're supposed to do what to the account? When your assets increase, you do what? Debit. So you're supposed to debit the fixed assets and credit TS Supplies, but they did it the other way around. We call that the complete reversal of entries. You remember that error? When you debit where you're supposed to credit and vice versa. And that is one of the errors that does not affect the trial balance. So we're skipping that out for now as well. The last one, the total of the analysis column for stationery in the petty cash book, 150, had not been transferred to the stationery account. Stationery is an expense. Expenses are always what? Pride, purchases written inwards, drawings, expenses is always what? Debited, right? So we were supposed to debit our stationery account and we didn't. So the double entry to fix this would be to debit the stationery account and credit where? When is the error that does affect the trial balance? One of a part of the double entry is always what? Start with the S. The suspense account. So if we debit stationery, we have to credit the suspense account, which is what we did here. We credit the suspense account 150. Now, if you add up this credit side here, it actually adds up to 368. That means we did everything correctly. Most likely, the debit side and the credit side are equal. We total it. We finish with the suspense account. We move on now. They said B, prepare journal entries to correct errors which did not require correcting in the suspense account. Include a suitable narration for each entry. So we are not correcting any errors that we just dealt with here. We're only going to do the ones that we left out. So the first one, a check received from the EC. So if we receive the check, will we debit or credit our bank account? Debit. So we debit bank, which means we were supposed to credit the EC, right? But instead of crediting the EC, we credit DDE. So we have to take it out of DDE's credit side and then credit the EC. To take it out of DDE's credit side, what will we do? Debit, correct. So you debit DDE and then you credit the EC where it was supposed to be, right? Which is what we did here. Debit DDE Limited, credit the EC Limited, and then in narration I put to correct error of commission. Just to let the examiner know, hey, I know there's an error of commission, right? The second one, repairs for motor vehicle 293 had been debited into the motor vehicle account. That's an error of principle when you put it in the wrong type of account. I think I left out this one by accident when I was going through the errors before. All right, so right now, all you have a motor vehicle that worth $293. Right? There's no motor vehicle like that. So we debited motor vehicle account when it's not supposed to be there. To take it out to the debit side, what will we do? Credit. And then we'll have to debit the repairs account where it was supposed to be. Any general journal, they always put what's being debited first. So I debit more motor repairs, and then I credit motor vehicle, and I put my narration to correct error of principal. Please notice, every time I credit, I'm indenting. Always do that in a general journal. The space between the details and the amount is supposed to be the same. All right? So this space here and this space here should be the same. The last one, complete reversal of entries. We credit fixtures when we're supposed to debit it, and we debit TS when we're supposed to credit it. Remember, for complete reversal of entries, to correct it, we're supposed to double the amount. So to fix the credits on the fixtures, I would debit fixtures 3,000 to cancel out the credits, and then after debit it an next 3,000 to put it on the debit side where it's supposed to be. Same thing for TS. I have 3,000 on TS debit side. I have to credit TS 3,000 to cancel out that 3,000. Then credit it and next 3,000 to put it where it's supposed to be. So in total, after debit and credit, 6,000. Debit fixture 6,000, credit TS 6,000. Put my narration to correct complete reversal of entries, and I put my totals, 8 marks. Then they said, Costco Sports Center draft income statement for the year ended 31st of December 2024 showed a net profit of 13,000. But remember, we just corrected some errors. So that net profit will have to get some adjustments, right? Prepare a revised profit statement for the year ended 31st of December, taking into consideration the correction of those errors which would have affected the net profit. So let's see. Start off with net profit, 13,000, and let's see which errors would affect the net profit. Purchases account, for sure, that's part of the income statement, right? So that would affect the net profit. Before, we left out $18, right? Purchases is subtracted from your sales to calculate gross profit, then net profit. If we left out $18, that means we did not subtract that $18. So we have to subtract it now. So that adjustment is what we'll do. We'll subtract $18 from the net purchases, from the net profit. Sure. The second one, a check received from DEC Limited have been credited to DDE Limited. Is that has anything to do with the income statement? No, right? So we leave that out. Third one, petty cash book have anything to do with the income statement? Fourth one, repairs on motor vehicle, which is an expense, and the motor vehicle account. Any of those have anything to do with the income statement? Yes, expenses, correct? So initially, we had put the 293 in the motor vehicle account. So we left out the expense. Now we put in the expense. What do we do with the expenses in the income statement? Do we add or subtract expenses? Subtract. We subtract our expenses, right? So now that we have the expense, we're going to have to subtract it, which is what we did here, right? Everything in brackets means subtract. Third one, fifth one, sorry, purchases of fixtures on credit from TS. Does that have anything to do with the income statement? Do you put assets in the income statement, or does that go in the balance sheet? So that has nothing to do with the income statement. And the last one, stationery is an expense. Are expenses in the income statement? Yes, they are. Before we didn't have the 150 for stationery, we corrected that error. Just like with the repairs, we have to minus that 150. So I got the total that I was going to minus, and I subtracted it, and I got my adjusted net profit. And that's the end of January 2025. If we covered those topics, this would have been a very, very, very easy paper. This is the nicest POA paper I've seen in a while. All right, I will encourage you all to go through it, go through the previous past papers, make sure you all could answer every question here, and continue working towards May, June coming up. Right, I'll have a lot more papers like this loaded up for those who are watching online. So feel free to like and subscribe and scroll through to see other papers. I'll have for other subjects as well.